Ladies and gentlemen, we are gathered here today to let's talk about Coca-Cola earnings, baby. We're hyped for this one, okay? We wanted to see these. That's right, the market's actually taking a little bit of a tumble, but Coca-Cola holding strong here, up 1.7 so far today. They reported earnings this morning, and we'll take a little peek see at them, see what's going on with this stock. So, I must be honest here. I'm quite impressed with these earnings. If I'm just going to blow this one out right now, I don't know what I just said there, and I hate that I said it, but I said it. Coca-Cola Q3 non-GAAP EPS of 55 cents, beats by 9 cents. Good on that aspect. GAAP EPS of 40 cents, misses by 6 cents. Not shocked that they miss on that aspect. What I'm impressed with here is the revenue line. So, revenue of 8.7 billion, down 8.4% year over year, but beats by 330 million. I'm somewhat impressed with that, just due to the fact that a big portion of their restaurant business was wiped out. I mean, you're talking something that accounted for 40% of their revenue. If you look at last quarter, 40% of their revenue was gone. And now to see that reduced down to 8.4, even though there's still plenty of shutdown going on. Some restaurants didn't open until, 2 months through the quarter, 2/3 through the quarter, they were still shut down. So I'm relatively okay with those numbers, all things considered, thanks to that beat. Organic revenue was down 6% versus a consensus of 8.5. Good on that aspect too. Really, overall, the organic revenue is quite a big deal for investors right now. So, um, Coca-Cola says revenue trends improved, although pressure in the away-from-home channel remained in place due to the pandemic, as in restaurants. Organic sales 6% due to a 3% decline in both volume and price mix. Organic sales were down 3% for North American business, while Asia Pacific was down 8%. Operating margin was 30.4 versus the consensus of 27.6. Good on that aspect, and over a year, what they were a year ago is good too. Coca-Cola anticipates approximately 3% currency headwind based on the current rates, and including the impact of hedged positions, and a 6% headwind for comp operating income. Full year revenue and profit guidance wasn't given. What a shocker. And I buy that because, again, you never know who might be shutting down again or what this might look like. So we've got the earnings slides. Now, we love talking about earnings slides more than anyone. I love when a company gives me slides all the time. So let's look right into them. Let's do it. As we go onward, after we've addressed some business here, don't you worry. Overall, continued rebound. Sequential improvement. You see overall in volume. Overall volume is down 16% in Q2 now to just 4%. And as I mentioned, away from home volume was down 50% last quarter. What the crap? Or in April, I should say. For the full quarter, it was around 40% down. Now it's down to just the mid-teens, Good deal with that. And at home, volume growth in e-commerce actually showed continued strength. There was growth in at home numbers. But again, the away from home is pretty rough. North America down 6%, Latin America 4%, global down 11%, Asia Pacific 4%, and EMEA down 3%. So obviously Costa Coffee, as we talk about them, almost all stores are open. They're improving. Store reopened successfully. Good for them. Greater than 1 million new app users. Can you believe it? I can believe it. From Costa Express machines, pretty dope. It's like a Coca-Cola Freestyle machine, but for coffee. A little bit of mid single digit growth in like-for-like sales versus prior years. Launched in 13 Coca-Cola Hellenic markets, or what? Accelerated digital and touchless solutions. So again, these machines are pretty cool. And from the at-home offering, they are the fastest-growing brand in bean and pods in the UK. Oh yeah, ready-to-drink awareness and distribution is growing faster than any company. Can you believe it? I don't know. I can believe it, I guess. Share performance continues to be impacted by channel mix. No shocker. Positive underlying performance driven by strong share growth at in-home channels. So good stuff. I mean, there's growth in EMEA, Latin America, and just normal trademark Coca-Cola. You love seeing that. So, recovery, obviously, as they mentioned, is wild stuff. They're just mentioning overall how things work. Potential of, second waves, and then you go to phase 3, and then you're in, whatever we're done with this, how life is. So, obviously, focuses our optimized portfolio, disciplined innovation framework, and increased marketing effectiveness. Stepped up RGM and execution capabilities. Good stuff for that. Enhanced system collaboration and capture supply chain effectiveness and evolve the organization to invest in new capabilities. It makes sense. So the growth portfolio is important here. Portfolio combining strong global and local regions. You got good stuff here. They have a well-diversified portfolio of brands, and you see they do. Look at all these things down here in this chart. Look at all these different brands here. And then there's some brands that were, maybe didn't make the cut. Okay, maybe they didn't make the cut. Yeah, believe it or not, I don't know if it shows it on here in a more detailed way. They're actually getting rid of some brands. Some Coca-Cola brands are going bye-bye. Just so you know. Nothing that really is a winner for you, so it might be selling you drink, but for the most part, not necessarily something crazy. Let's see. As far as just overall brands, quality stuff here. They're talking about new brands from Topo, from my favorite band, from Coca-Cola Energy. Good stuff for them. They're gaining some market share in terms of that stuff. So overall, fun stuff. 30% of our business has at least one brand that is packaged with 100% recycled plastic. Good for them. Good for you. I'm proud of you for that. Overall basic steps as well. From results perspective, some numbers. Unit case volume down 4%, organic revenues down 6%, operating income up 7%, excuse me, and EPS 55 cents. So good stuff there. So obviously portfolio optimization is part of it, as I mentioned there. As far as cutting some of those brands out, they want to make the optimized portfolio that'll actually be the best growth for them. So if they see certain areas or certain brands that really just aren't selling and are not cutting the cake, if they're not driving any growth or really any sort of profit, why are we bothering with them? So that's what they're doing here, kind of refining their business, which I get. They have a lot of different brands. And again, as we saw, they're not giving a full guidance on that aspect either. Kind of boring. I want to get some guidance, but I guess I get it. Obviously, focuses are reinvesting capital in the business, and continuing to grow the dividend is a big thing of that. So obviously they grow every year, and they're going to continue to do that. Now the only issue is they didn't give me a balance sheet for this quarter quite yet. The 10Q isn't released, so we can obviously look at last quarters, and it won't hurt us too much. Where you see overall current assets here Total total current assets line of 29 billion versus 20.4 billion. So you see this growth here. It's good stuff. It's good stuff. Total assets in general, 94.6 billion versus 86.3 billion. And from a total liabilities standpoint, total current liabilities, you see 26.8 versus 26.9 or 28. Yeah, you go. Oh gosh, I'm sorry. I'm so sorry. This overall leads you to a total stockholder equity of 19.1 billion versus 21 billion. So they did decrease stockholder equity. So I'm curious to see what this quarter looks like for them. Obviously, the EPS line grew over last quarter, so they should probably be better on that aspect. The balance sheet should have seen some recovery. But again, this year is just a pretty crappy year for them. I don't find any fear for them in terms of dividend. I mean, $19 billion extra in cash is pretty beautiful. So that's Coca-Cola for you. As far as buying the stock, I still think it's not by any means at a valuation that I think is ridiculous. I mean, you're talking about a P ratio of 24, market cap 219 billion is not too crazy when we talk about returning to normal levels, where we see annualized revenue closer to 40 billion, a little bit over that. I mean, then the valuation just doesn't seem crazy for a dividend yield over 3%. I'm pretty okay with Coca-Cola at these levels. If it's a good base to a portfolio as far as buying is concerned. So, yeah, that's all I got for you.